Good afternoon and welcome to the INSTEM PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit two polls. And I'd now like to hand you over to Phil Reason, CEO. Good afternoon, sir.
Thank you very much and welcome everybody. Great to have a chance to talk to you all. We'll be cameras on for a few minutes while we say hello. We'll switch cameras off so we're not eating up your bandwidth. I'll introduce myself while the polls are coming up. So Phil Reason, CEO, been with INSTEM, or something called INSTEM, since 1982, moved to the US in 2003. As you'll see from the presentation, the US represents over 50% of our revenue and our target market. And we are also very acquisitive, and well over 50% of our target acquisitions are in North America, which is what finds me in the US. Nigel, would you like to introduce yourself?
Sure, thank you, Phil. Yes, so I'm Nigel Goldsmith. I'm the Group CFO. I'm based in Stone, Staffordshire, in the UK headquarters. I've been with INSTEM since 2011, joined as CFO, and I've been involved in all the acquisitions ever since then. My background is one of a qualified chartered accountant. I spent my time in public practice primarily with KPMG, moved into industry in the mid-90s, and I've been with healthcare, life sciences businesses ever since then. John.
Yes, thanks, Nigel. So John Horton, I am the newly appointed Vice President of Investor Relations. I have been with INSTEM for just celebrated my 6th anniversary. I actually came to INSTEM by way of the DWise acquisition, but I've been in the life science industry for 20 years now, having worked in both pharmaceutical and CRO, clinical research organizations. Prior to taking on this role, I was the head of our global service delivery operations, which was our consulting organization, our PMO, our quality, and our clinical trial transparency services. So very happy to be in this new role and very happy to be here today.
Thank you very much, John. We will switch our cameras off. Well, thank you to those who have answered the polls. Great to see that 80% of you are indeed INSTEM shareholders. Thank you very much. And over 70% of you have attended an INSTEM investor presentation previously. So we will try not to bore the people that have listened previously, whilst giving those people that haven't heard us present some insight into INSTEM. We'll leave hopefully plenty of time for questions. And who are INSTEM? So we are a world-leading provider of software and outsourced services. The software falls into two categories: workflow software that helps clients manage a variety of laboratory experiments and clinical trials through to early phase clinical trials, and a provider of data solutions that allow people to generate insight from large volumes of historic data, ultimately, we hope, replacing some of those laboratory studies and clinical trials so that clients can do their R&D more efficiently, more quickly, with data and insights rather than experimentation. All of that driving towards helping our clients bring their life-enhancing products to market faster. You know, this is what gets our staff out of bed every day. It is wonderful to be working in this industry and supporting this noble work. You know, never any truer than the work we've been supporting our clients with COVID vaccines and therapies over the last couple of years. Apologies. Next slide will end up being a little redundant because it's introductions. I will jump past that. So, INSTEM at a glance. We've been providing solutions of this type for over 40 years. During that period, we've amassed a blue chip client base and have been involved with a huge proportion of the life sciences products that have been approved for marketing. Over 50% of the world's marketed drugs have been through INSTEM's platform at some stage during their R&D life cycle. Today, we are representing or supporting the vast majority of life sciences research and development around the world. Historically, because we've been providing software for so long, our clients deployed our enterprise software solutions on premise, their own premises, in their own data centers. But over the last 10 or 15 years, as the software world has moved to software as a service delivery, we have been providing that alternative for our clients. And a couple of years ago, told all of our clients who deployed our software on premise that there would come the day when we would no longer provide new versions of software for deployment on site, that they would have to move to SaaS delivery. This is sort of in their interests and in our interests, and has been well received by clients, and clients that are still on premise or on a journey to make that transition. We generate, as a consequence, recurring revenue from annual support and maintenance for perpetual licenses that we've sold in the past, and we generate SaaS subscriptions where people are renting access to the software. The sum of those two things represents 58% of our revenue, a little bit more in annual support than in SaaS, but over time that will reverse and there will be more SaaS than annual support. As a global market leader with large percentage of our revenue coming from recurring revenue, it's really important that we hang on to those clients, that we don't see attrition of our clients and our recurring revenue. And it's great to be able to once again report on a key KPI, which is the rate of retention of our recurring revenue. We've been able to report that that KPI has exceeded 98% every reporting period since we IPO'd in late 2010. Just looking back over the more recent years, back to 2017, we've enjoyed strong growth, a mix of organic growth and growth through acquisitions, with a compound annual growth rate of 21.5%. I'm not going to talk about the more detailed numbers at the bottom of this slide. Nigel will come on to talk about those. Suffice to say, we're really pleased with our half-year results, with all of the key metrics very positive in the first half. Bear with me a second. The button to advance the slides has decided to disappear off the bottom of my screen. Okay, I have it back. So our business is organized into 4 market-facing business units: study management, regulatory solutions, in silico solutions, and clinical trial acceleration solutions. These fall into the 2 categories of workflow software or data solutions, and are all involved with the collection, analysis, reporting, and submission of complex data to regulatory agencies around the world. Study management, helping people to plan, schedule, then do the conduct and data collection of results during studies, to do the analysis at the end of those studies, and to produce the scientific narrative that explains the study results. Regulatory solutions take data that comes from study management, maybe our study management applications, maybe our competitors, and reformats the data into the mandatory formats necessary for submission to the regulatory authorities, mainly the US Food and Drug Administration. In silico solutions, it is all about taking large volumes of historic data and running sophisticated predictive analytics, AI, insight generation, so that you can learn from what you've undertaken before, maybe remove the need to run studies altogether, or to optimize the study design based on what you're researching today and how similar it is to things that you've researched in the past. And clinical trial acceleration was created for the first time last year with one of the 3 acquisitions that we undertook last year, a business called DWise. And this area has focus in 2 particular aspects of late-stage clinical trials. The biggest one, providing statistical computing environments that the statisticians and data management professionals, SAS programmers use to analyze large volumes of clinical trial data and to format it in the way that it needs to be presented to regulatory agencies. The other part of this business, a little smaller, is associated with the anonymization of clinical trial data for 2 purposes. One, so that it can be submitted to 2 of the regulatory agencies, the European Medicines Agency and Health Canada, both of whom mandate that you provide anonymized clinical trial data as part of them being willing to approve your drug for marketing. And the other reason why you might want to anonymize your clinical trial data is because you want to use it in wider research beyond the study for which the participant gave their permission. And you're only allowed to do that if you anonymize that data so the subject cannot be identified. So they're the 4 areas. We will talk a little bit more about this as we move on. Those 4 areas are now presented on a typical pharmaceutical R&D timeline. So that line across the top that goes from 1 year onwards. And I noticed in a presentation earlier today, it doesn't matter how many times you check this, that we go year 10, year 11, year 12, year 11. That should say year 13, which is on average how long it takes to bring a new drug to market. The clients spend typically somewhere around $2.6 billion getting to that point. And then they have 7 years of remaining patent protection to recover the cost and the profit on that drug before generic competitors can enter the market. Our solutions span early discovery to post-marketing. The importance of that is, for our in silico solutions, what we want to do is have access to an intimate understanding of data that comes across this life cycle, because that's what makes the insight generation most powerful, if you can combine, aggregate, and generate insight from the broadest range of historic data. Just a little bit of information on how INSTEM is represented around the world. From a revenue perspective, on the left, 55% of our revenue comes from the USA, 24% from the UK and mainland Europe, and 21% from the rest of the world. As a consequence, as we're providing very sophisticated solutions that really rely on having people present in the geographies that we do business, we have 136 of our people in the USA, just a little under 200 in UK and mainland Europe, and 150 in the rest of the world. These are people that are involved in selling, marketing, delivering services, providing support to our clients, with a slightly more focused group of people doing research and development, which tends to be on the east coast of the US, in the UK, and increasingly in a software development and engineering region in Pune in India. You will see at the bottom of this slide that we have over 700 clients globally. That is a mix of pharmaceutical companies, chemical companies, contract research organizations that do a huge proportion of the studies supporting the end user clients. And if you look to the pharma industry, we have all top 25 pharma companies. We have most of the top 100. We also have a huge number of academic clients who are frequently involved in the earlier stages of the development of new drugs and chemicals, and also source a huge proportion of the scientists that might gain their first exposure to our technology and academia, and then go on to industry and encourage its wider use in an industrial setting. The business has been growing strongly. You see here just the last 6 years of revenue growth, growing steadily from 2016 to 2020, and then helped by the 3 acquisitions that we undertook in 2021, a step change to 46 million pounds of revenue, and that organic and acquisitive growth will contribute to a full year contribution from those acquisitions that expects us to have revenue of around 60 million in 2022. You can see that recurring revenue, that as I've mentioned is important to us, 58% of current revenue has been growing strongly. SaaS been growing strongly within that, slightly more strongly than annual support, and the profit has also been growing strongly over recent years. One of the major reasons for our growth and success has been that we operate in a particularly vibrant and resilient end user market. This is just talking about the pharmaceutical end of that. We support life sciences R&D for chemical companies, for medical device companies and others. But you can see here the rate of growth in the pharmaceutical industry, 3 to 6% compound growth, growing to $1.6 trillion global spend by 2025. Pharma R&D expected to grow to $254 billion, clearly where we generate all of our revenue. And going to our introduction of in silico solutions, a huge growth in the analytics aspect of life sciences, expected to grow to $42 billion over the next few years. You can see below those 4 business areas again, the total addressable market and our revenue that we've generated in the first half of this year. So you can see that in all areas, whilst we are well represented, generate good revenue, are typically a market leader, there's still huge growth opportunity in each of these areas based on the total available market. As most of you have listened to an INSTEM presentation before, you will have seen this slide, which is the total number. The chart on the bottom left is the total number of drugs in the regulatory stages of the global R&D pipeline. You can see that that has been growing nicely over the last decade or more, and has grown particularly strongly from March of 21 to March of 22. This data is published annually, and you can see it was up 8% year over year. The more drugs in the R&D pipeline, the more staff are needed to undertake the studies to support those drugs, and the more staff that are needed to do that work, the more users of our software we sell, and the more outsourced services that we receive to support the studies that are being undertaken. So this dynamic has been extremely supportive of INSTEM's growth over the last decade. Within this, we have 3 pillars of growth: organic revenue growth, margin improvement, and accretive M&A. Overall, INSTEM is targeting growth to revenue that will be roughly double 2020 TWO's revenue of 60 million to 120 million plus organically and acquisitively over the next 3 to 5 years. We are guiding towards expecting on average 10% compound or annual growth. That varies a little bit solution to solution. There are some solutions that are more mature where growth is maybe more modest, 7 or 8%. Solutions that are not as mature within the market, so in silico solutions are much newer. Growth there should be in excess of 15%, but on average, as we look across the business, around 10%. This growth is helped by that large client community we have that are continually looking to take more solutions from INSTEM, either things in our existing portfolio that they haven't yet licensed, and a lot of our revenue each year is generated from existing clients buying new things from us, as well as us introducing new solutions year on year and having more in the portfolio to cross-sell. Margin improvement, if we look back to 2020 and 2021, our EBITDA margins were around the 20-21% level. Nigel will come on to talk about margins in the first half of this year, which were lower than that, and the reasons for that. But we are targeting EBITDA margins of 25% plus over the next few years. We believe that is eminently achievable. There are some of the strategies to achieve that below. Moving more people to SaaS is certainly very helpful. And as we grow, gaining the efficiencies of leveraging our global platform and doing that without having to increase the cost of that platform as fast as we generate revenue growth. Where we can be particularly efficient is to take advantage of some of our lower cost regions. So the Pune region that I talked about, we are just establishing a development operation in Romania to complement what we do in Pune, and taking more advantage of those regions will lower our average cost of our staff and increase margins. And then the final element of our growth strategy around accretive M&A. This can be outright acquisitions, or it can be expansion or increasing our range of strategic partners. We have a handful of really important strategic partners today, typically where we help take their technology or solutions to market and complement our solutions. And there's definitely more we can do in that area. Software as a service is a key focus for us. I've mentioned that we are transitioning all of our clients over time to deploy software as a service. We have set a deadline of the end of Q1 2024 for all of our enterprise clients to move. And that has made steady progress. This is actually one area that has slowed down a little bit through COVID. Our solutions work extremely well if deployed in our client data centers, and they had other priorities to address through COVID, and so delayed some of their transition to SaaS projects. They are now picking up again, and we're likely to have a very busy year next year as we complete a lot of that work ahead of the end of Q1 2024 deadline. Deploying SaaS allows us to have our clients on the latest versions. This gives them access to the latest features and functions. It allows us to sell new modules to them that maybe only work against the latest versions. And this is beneficial to the clients, gives us greater visibility, higher quality of earnings. So is a real win-win for INSTEM and our clients. You see here some of the more recent history of M&A acquisitions undertaken post-IPO. We had been acquisitive pre-IPO. 9 acquisitions in the strategic bucket, and one that was both strategic and transformational. The one that John came from, DWise, last year, that was much bigger than the average size of the other 9, which were typically $2 to $5 million in revenue. DY's brought over $20 million in revenue to us and has helped transform the scale of the INSTEM business. M&A for us is driven by a desperate need our clients have to consolidate a very fragmented landscape of IT suppliers. It's very costly for them to deal with so many suppliers. And with so many suppliers, it's very difficult for them to aggregate data, which is something they want to do. And so they are very supportive and encouraging of INSTEM. They're often the people that are suggesting acquisition targets to us and then enthusiastically embracing those acquisitions when we bring them under the INSTEM umbrella. Funding of acquisitions has been a mix over the years of funding from operational cash generation. We've generated cash every year since we IPO'd. We raised some money when we IPO'd. We've done 3 further equity fundraisings, including the largest one that we'd undertaken in the middle of 2020. We used that funding to complete the 3 acquisitions last year. And Nigel will talk a little bit more about a debt facility that we put in place that also may feature as we look forward to acquisitions in 2023 and beyond. And because it's a very fragmented market, because there are many acquisition targets out there, that helps us be very disciplined around our criteria for acquisitions. We're looking for businesses that are already profitable, can be accretive to earnings in their first full year, and that can deliver, among other things, return on capital of 10% immediately and growing rapidly to 15% plus. With that, let me hand over to Nigel, who can take you through some of the H1 highlights.
Thank you, Phil. Can you hear me okay?
Yeah.
Thank you. So this is just a snapshot of the H1 highlights, as Phil said. There's a lot of detail in the RNS announcement that was made this morning. So please drill down into that and you'll got a lot more information than I'll be presenting on the next few slides. But nevertheless, at high level, group revenue is up 39% year on year, of which SaaS 29% growth. And Phil will talk a little bit more about the SaaS generation, but very much a key part of our strategy going forward. EBITDA in absolute terms up 8%. Recurring revenues, again, significant growth, helped by the acquisitions that we made last year. And our recurring revenue is defined as the SaaS revenues plus our annual support and maintenance fees that are generated from the perpetual licenses that we sell. And a gross cash position at the end of June of £10 million. Lots of detail on here. I won't go through every line, but just some of the highlights from here. So revenue, 39% growth year on year, as I mentioned. Constant currency basis would have been 34%. So we had a 5% benefit through the US dollar, primarily the US dollar rate to GBP. Our recurring revenues, significant growth again, in both in absolute terms and also as a percentage of revenue. We were down at 50% last year, up to 58% as a percentage of total at the end of June this year. In terms of costs, our majority of our costs are payroll related. We have just under 500 people now working for us globally. We've been, as with most businesses, we've been under pressure regarding salaries, and we put through a greater than average salary increase at the beginning of January this year. And that was impacting the cost base and also therefore the profitability in the first half of the year. Development costs continue. We've not slowed down, representing around about 15% of our total expenses. And we capitalize around about 40% of those development costs, both on the INSTEM organic business and also the acquisitions that we acquired last year have continued to develop their products as well. As Phil mentioned, EBITDA percentage only 16% of revenue compared with the 20% 1% that we had this time last year, and say primarily driven by some of those inflationary cost pressures that we experienced in the first half. We've reacted to that by increasing our sales prices, but we won't see the benefit of that really coming through until fully anyway until towards the end of this second half and the beginning of 2023. In terms of the constant currency, we have a natural hedge against our US dollar exposure on the basis that we have some significant cost based in the US through our offices and our people over there. So there's a natural hedge against the any revenue exposure. So in fact, the bottom line impact of that £1 million benefit was only just under £200,000 at profit level. I've just mentioned on this slide down here that pension scheme, we have a defined benefit pension scheme in the group, and the deficit has reduced again down to 1.3 million at the end of June, basically through favourable market conditions as well, and future expectations, as well as continuing contributions by the group of around about £600,000 per annum. We're getting to the stage now where we can look to think about equalising the liabilities and potentially look at some sort of buy-in opportunities. So that's under consideration at the moment, and obviously we'll provide guidance to the markets in due course. On terms of cash generation, disappointing really in the first half, 1.8 million relative to the prior year. I think we were blessed somewhat with the cash conversion last year, where it was for the full year was over 100% of the company's EBITDA. So there's been a little bit of a reversal of that in the first half of this year. We have had some impact on our working capital, whereby we are looking to make sure that we have sufficient resources in all areas of our group, including the new acquisitions, and making sure that we have then their availability and liquidity at all times. So that's playing itself out. We anticipate cash generation to improve in the second half and into the new year. So no concerns regarding any debtors. There are no changes to terms and conditions with our customers, and so we anticipate getting back onto a normalised level in due course. And I must say that this time of the year, the half year, as a typical cycle, is one where we have our lowest cash point during the year at the half year, with our annual support and maintenance revenues. We typically invoice those at the end of the year for the calendar year ahead, and therefore collect cash at the end of the year and the beginning of the calendar year. And so the low point of cash tends to be during the summer and autumn months, and then picks up again in the quarter four and Q1. We've talked a bit more about a little bit more here about revenues, this time splitting them on a segmental basis on the left-hand side, as you can see through the bars, the historic segments or business units that we've offered with study management, regulatory solutions, and in silico, the three portions of the bars in 1920 and in the first part of 21, and then with the acquisition of DWise, bringing the clinical trial acceleration business unit to the business. That's the green portion of the top of the bars in 21, as you can see, significant growth in 2022, and therefore contributing significantly to the overall growth, which is why we see this as a transformational acquisition for us. The revenue split on the right-hand side just gives you a little bit more granularity regarding what comprises the recurring revenue, licenses, and service income through the revenue type. As you can see, compound growth of significantly right across the board, really, wherever possible, with the exception of license fees, which have remained flat over the period as we move more and more to the SaaS platform and more to recurring revenues as we see that growing. And our annual recurring revenues at the end of June at 32 million, so nice platform and visibility for the year ahead. This slide shows the obviously cash water flow, showing the movement on the cash in the period. We made deferred and contingent consideration payments of the three acquisitions from last year. We were pleased to announce that all contingent consideration targets were met in the first half. and therefore we've paid what was due in the first half. We have another £1 million to pay in the second half, and then the final payments for contingent and deferred consideration on those acquisitions will be made in the first half of next year, and then we'll be clear again of any debt. On the right-hand side, I'll just draw your attention to the 20 million debt facility that Phil referred to before. So this was a facility, we've never had a debt facility of this magnitude before. We decided that we wanted some firepower to help us with our acquisition strategy. We've negotiated an up to 20 million facility with HSBC. On a transactional basis, we are moving most of our banking facilities across the globe to HSBC. But we also have a 20 million, of which 10 million is committed funding and 10 million of uncommitted funding, although there is an expectation that that will be made available to us if we chose to draw down on it. So together with our gross cash and organic cash generation, we have sufficient cash both to ride any storms in the market, but also more importantly to take advantage of opportunities that present themselves. There are a number of operational and strategic highlights here, most of which Phil's already touched on. I just draw your attention to the third and fourth bullets on the operational side, where we have continued to have very active engagement with industry, with the FDA in the US, and also with our clients in terms of understanding their needs and therefore developing our services and products to meet those needs. And we feel that that is really important, particularly in the in silico area, where we see some significant growth opportunities. And on the strategic side of the business, the final bullet there, just to mention the announcement that we made post period end of the largest contract win that we've ever had at $12 million for the new Aspire software product that has been developed through the CTA, the DWise business, and we have a lead client there, a very large CRO, contract research organization. We will see the majority of those revenues come through starting next year, although there will be revenues in the second half of this year in relation to that. And finally, on the numbers, just geographic split, just showing really what Phil was referring to before, North America or USA particularly being the largest proportion of our revenue streams. But as you can see on the left-hand side, growth in all territories across the world, some of which was brought by the acquisitions last year, and particularly growing in North America, and we see that continuing as we go into the future. Over back to you, Phil. Thank you.
Sorry, mic was off. Great, thanks, Nigel. So just coming to the last slide. So thank you to those who've already entered questions. We'll turn to those in a moment. If you haven't yet typed your question in, it would be great if you could add it. So in summary, hopefully what you've heard is that INSTEM is a tremendously resilient business operating in a very defensive industry in life sciences R&D. We generate great revenue growth organically and acquisitively. We are profitable and cash generative. We have good and growing revenue visibility through our recurring revenue. We are highly respected and work very collaborative in an industry people are proud to work in and proud to work with. Because of the industry we're in, the fact that we have a growing world population, an aging world population that needs ever more healthcare, there will continue to be opportunities in terms of consumer demand, but equally huge opportunities to help our clients reduce the cost of their very expensive R&D and to reduce how long it takes to bring these things to market, and a lot of which is going to be driven by new and innovative technology, of which INSTEM will be part. Not only have we operated organically successfully, but we've got a strong track record of M&A. We've had tremendous support from The capital markets, thank you to you all that are part of that. As I mentioned at the beginning, many of you are very supportive of INSTEM shareholders. Together we are doing great things to help a really important industry. And as we look forward to the future, we are very positive about the near-term outlook and the medium-term outlook as we continue to grow and develop as a business. With that, I will turn to questions. And the first one from Jonathan, what has been your revenue growth in half one 22 versus half one 2021 on a pro forma or organic basis? Unfortunately, although we would normally distinguish between organic growth and inorganic growth period on period, it isn't possible this year because the acquisitions have been very intimately integrated. And one of those acquisitions in particular, the PDS acquisition, a direct competitor, we have combined sales pipelines and we have retired competing solutions, and we're now only selling one set of software solutions and one set of outsourced services. So it is impossible to distinguish between the contribution made inorganically by the PDS business because it's been so tightly coupled. Organic growth has been good, but it's not possible to break it out. Sorry about that, Jonathan. We will, subject to whatever might happen with acquisitions in the future, we will ordinarily split out that growth. David, can we expect similar levels of revenue growth? Is it set to continue? Absolutely, on an organic growth basis, we expect to continue to grow strongly. Our M&A program is very active. We have appointed a new buy-side investment banker, Results Healthcare, 9 to 12 months ago. They've been working very collaboratively with us to map the wider acquisition landscape that's available to us because of the acquisitions we've made in late-stage clinical of DWISE, in early discovery with the Edge last year. And we are homing in on 3 or 4 niche sectors of life sciences R&D for acquisitions. We're reaching out to targets. It's unlikely we will get something completed this year, but we are optimistic that we will be able to add further acquisitive growth in 2023. Likely to be bolt-on size deals, so those bringing $2 to $5 million, maybe a little bit more, rather than more transformational size deals. Valuations remain pretty robust for private businesses. The bigger transactions, there's a smaller number of, and valuation multiples as such for those bigger businesses at the moment that we're more likely to concentrate on the bolt-on transactions where we can find great businesses at reasonable multiples. Thibault, maybe a quick word regarding this dispute with a client through the German courts. Could you give a bit of colour on the story? And if that the settlement is the end of it, are there any other disputes? Nigel, would you like to pick that one?
Thanks, Phil. Yeah. So this was it was a contract that we had with a customer going back to 27. Well, in fact, prior to that, 2016 probably, but 2017, the customer decided to exit the contract, and therefore the dispute began. Really, the customer had paid us fees for acquiring one of our products, and they wanted their money back essentially. So this has been dragging on, as you can tell, for 5 years now. The judge in Germany gave his opinion on this very recently and gave his verdict, and essentially we have paid back the monies that we received all those years ago, and the customer has given back the software, and therefore we're walking away, shaking hands on it, and that's the end of it. So it is a full and final settlement to your question, and and it's a one-off, non-recurring. We hope it will never be repeated for obvious reasons. In terms of other disputes that you've asked about, no, we don't have any other disputes in play at all at the moment. So this is the one and only one. So we felt it was important as a board of directors and for the benefit of the shareholders to really draw a line under this now, not let it drag on, not have that uncertainty in the market, and therefore just settle with the customer and move on. So that's what we've done.
Thanks, Nigel. So Theo, again, could you also give a word on the organic dynamic in the first semester in terms of top line with a bit of granularity between SaaS, recurring and services? So part of this, obviously, the split of organic growth we've talked about. Granularity on SaaS and recurring. So SaaS for new business has grown really strongly. SaaS conversion for existing clients, because some clients have delayed the point at which they're going to make that transition. At the point we make that transition, we reclassify annual support and maintenance to SaaS. So that has actually been a little lower for the last year or two, and that opportunity still exists in front of us. Only about 25% of our on-premise clients have so far made the SaaS move, so there's a great opportunity to continue to grow that revenue at the point they make that transition. We have also, you may have seen that analyst guidance with these results has changed the mix of revenue, a little bit less service revenue, because we've enjoyed lower service revenue in the first half, particularly in the consulting, in the clinical trial acceleration business, and also in send outsource services. But it's expected to be replaced by higher margin software business through this year. Both SaaS revenue, but also some perpetual license revenue. So although we're not pushing to get perpetual license revenue, the underlying life sciences R&D market is so robust that we've got clients that are still using our software on premise. They need more users for our software, and they are buying more perpetual licenses. So software revenue will be very strong this year. The SaaS revenue, because it's recognized monthly, extra SaaS revenue, at a revenue level, it won't be enough to replace the services that are slightly lower. So overall revenue guidance is down a little bit, but profit guidance is maintained, which at the end of the day will help our EBITDA margins. So hopefully that answers that question. If I'm not mistaken, you've now fully integrated the last 3 acquisitions. That means you'll be active on the M&A side. Maybe a bit more color on what you're looking at in terms of business size, in terms of revenue, but also your firepower and multiples you're willing to pay. So comprehensive set of questions there. Thank you on M&A. Some of this we've touched on. Bolt-on size transactions, revenue probably $2 to $5, $2 to $8 million. In terms of what we're looking for, our in silico business has grown really strongly. There's huge demand for it. This is the area that has the greatest promise to reduce the cost of R&D. So keenly of interest to our clients. Our business is growing strongly, but it's the smallest area of our business by revenue. So it will come as no surprise that we're looking at M&A targets in that area to add greater scale. It is an area where there's lots of small businesses that have developed some interesting technologies and services, but are wondering how they grow their business from maybe a few $1 million to multi-million dollars, and that's where INSTEM can be really helpful. We can give them that global access to sales, marketing, service delivery. We can give them access to the INSTEM client base to be able to sell their solutions. So that's definitely an area of interest. And then another example is in that late stage clinical trial area where the split between software and consulting and services is a little bit lower on the software side than in other areas of our business. We would like to add to the software portfolio in that area. Now, some of that is happening organically with that great transition of our statistical computing environments to from a custom project basis to the new Aspire SaaS solution. But we think we can also add potentially software in that area, in areas such as our clinical trial anonymization space, where there are some competitors and complementary vendors that may prove to be interesting acquisitions, or in areas such as clinical trial design, where you have the ability to leverage large volumes of historic client data to better design your clinical trials, to use lower volumes of subjects. So maybe you can run a trial with 500 participants instead of 1,000 participants at less than half the cost, and considerably less time, because it takes a long time to recruit the volunteers for your trials. And if you have to recruit fewer of them, you can begin and complete your trials more quickly. So some example areas of where we will be targeting. Valuation multiples, they remain high. Historically, we've managed to be able to do acquisitions at anything from 5 to 10 times EBITDA. We're unlikely to find acquisitions at 5 times EBITDA in the current environment. You're likely to be looking at multiples at 8 to 15 times EBITDA, but still attractive things that will still be accretive at those levels. But there's certainly business out there that you may need to pay significantly more than 15 times EBITDA, but we are unlikely to be participating in those opportunities. Let's pick some different people. So Andrew, you mentioned that sales price increases were only put through reactively to input price increases. Could INSTEM perhaps become more proactive in increasing pricing, given its strong product and customer positioning? Margin seems surprisingly low at the moment. We have standard escalation clauses for prices in almost all of our recurring revenue contracts, and with recurring revenue representing 58% of our revenue. The price increases for those are very influential in our overall pricing opportunities. What we have put through this year is suggestions to clients that we increase prices by more than is actually contractually defined. The clients have every right to refuse that. The reality is clients have been largely pretty accepting that price increases need to be greater than is contractually provided for, because they recognize that INSTEM has a hugely talented team that provides great value to them, and they need to play their part in making sure that we can retain and attract highly qualified staff that will do a great job for our clients. We do routinely increase prices in other areas of our business as well as recurring revenue. But I think you're right, Andrew, there is an opportunity for new business to look at that and maybe increase those prices even quicker than we have done historically. Jonathan, could you please walk us through the decline in EBITDA margin in H1? How much of that relates to a shift in the mix due to acquisitions versus labour and other OPEX items? Nigel, you've talked a little bit to this, but can you provide a little bit more colour?
Well, I haven't got all the numbers to hand, really. I think this is one where I'll probably take it away, and when we put written answers to these questions, the ones we don't discuss today, I'll give a breakdown there. I think it should probably be easier. and I don't want to sort of just throw some numbers out. It's a bit of a combination, really, to be honest. It's a combination of a mix of revenues with different margins associated with those. Services revenue generally being slightly lower than the software revenues. The labour cost increases, as I was referring to, and other inflationary increases on the OPEX items as well. So it's a blend, really. I haven't got a number for each of those to hand. So I don't know if there's anything else you can add, Phil, to that, really. So.
Well, it probably flows nicely into the next question from Michael. Please, can you explain why sales haven't been quite as good as expected and why you hope this will improve? So the areas where sales haven't been quite as good are in consulting in our clinical trial acceleration business and in send outsource services. And sort of following on from Nigel's point, our cost base is largely fixed. It's our people primarily. And if we have slightly lower revenue inflow, particularly in the services area of the business, then whilst on a gross margin basis on those projects, the margin can be fine. If we're not utilizing our staff quite as heavily, then that can be a drag on EBITDA margin. So I would say that would be the only other thing immediately that comes to mind, Nigel, on top of the things that you've talked to. And to Michael's question, well, why is that? In the consulting area, the former DWise business, our clinical trial acceleration business, has been very successful over the years in winning and implementing multi-million-dollar custom statistical computing environment projects. They're great. They're with blue chip clients. They've brought a set of great relationships to us. But the challenge with those projects is that, there's a relatively small number of them, and you can't always guarantee that they all arrive at the perfect cadence. So, just as you're winding down on one project, another one is nicely ramping up. And what we've experienced during this year is we've got a set of those large projects that have been reaching their natural end of their project. And some of the subsequent opportunities in the pipeline have taken a little bit longer to close. And so we've ended up with a bit of a leaner period for consulting revenue during Q2, and it continued into Q3. There's some nice prospects coming through, including that one that we booked, that large project that Nigel talked about, that ultimately will generate great SaaS revenue. But actually, it has a $3 million implementation contract that is underway already and will run through to early Q3 next year. And we have some other nice sized projects in the pipeline for consulting. So that will pick up again. The other area, send outsource services, whilst we've had great order intake, we've actually had fewer studies sent through us, data sets sent through us to convert into send. There's no really good explanation for this, because study volume remains really high in the industry. So there are lots of studies being run, but for whatever reason, although clients have given us orders for send conversions, the data isn't coming through. We can only surmise that this is because some drugs, that they are getting a little bit more complicated. It can therefore get a little bit more challenging to pull the data together at the end of studies before it's sent through to us for conversion. So we have the order, but not yet the data. Or it could simply be that clients have been less successful with the drugs going through their development program, and things aren't being converted into send for submission to the regulatory authorities because those drugs have failed, and therefore a send conversion will never be needed. Over time, that again is likely to reverse. We are seeing a pickup in send outsource services at the moment. I think we managed to get through the vast majority of your questions. I'm conscious we're a minute over. There are one or two maybe that we didn't answer. If we didn't answer them, we will answer them in writing. Thank you very much to you for your questions. Thank you to the many of you that are already investors in INSTEM, and we look forward to updating you again, if not before, when we do our full year results in 6 months' time or so. Thank you very much.
Thank you.
And back over to
Alessandro.
yeah, thank you.
Phil, Nigel, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of INSTEM PLC, we'd like to thank you very much for attending today's presentation, and good afternoon to you all.